You know those viral photos where someone is holding up the Leaning Tower of Pisa?
Oh, yeah.
Yeah.
The tourist ones?
Right, exactly. And then, the camera shifts a few feet to the side and you realize they're just standing awkwardly in this empty plaza with their hands in the air.
Right. It's just forced perspective.
Yeah.
It's an optical illusion built entirely on the angle you choose to frame the subject.
And once you see that wider angle, your brain completely reinterprets what is actually happening.
Mm-hmm.
And I bring this up because right now, in the Indian stock market, we are staring at this massive financial optical illusion.
Oh, absolutely.
Because if you just glance at the mainstream headlines, smaller companies appear to be growing their profits at these astronomical, like physics-defying rates compared to the top 500 corporate giants.
Right. That's the narrative.
But today on the deep dive, we're changing the camera angle.
I like that.
We are digging into a fresh August 2026 data presentation from DSP Mutual Fund. It's called Fifth Things Large, Mid, and Small Cap Earnings Trends. And we're pairing that with a fantastic translation note from PMS AIF Leap ES that really strips away the jargon.
Yeah, and the crucial thing to establish here, before we even look at a single number, is we need to set the boundaries of our sandbox today.
Right.
We have to completely divorce ourselves from the stock market ticker.
Okay, so no share prices.
Right, no share prices, no valuations, no mutual fund returns, none of that.
Got it.
We are opening up the hood to look at the actual engines of these businesses over a 9-year stretch. So from financial year 2017 to June 2026.
Okay, so we're strictly looking at profit after tax, which is PIT, right?
Yes.
The actual money a company gets to keep. And revenue, which is the cash coming in the door from selling goods or services.
Exactly. We are looking at the fundamental business reality rather than, the narrative that the market has been bidding up.
Okay, let's unpack this. Because the headline number from this DSP Mutual Fund data is exactly what creates that optical illusion we were talking about.
Oh, it's a huge illusion.
Looking at the data since FY17, small cap profits grew at 36.8% per year.
Which is wild.
Yeah, that's a compounded annual growth rate, right?
Yeah.
Meaning it's not just a one-time spike, but growth building aggressively on top of previous growth year after year.
Right.
Meanwhile, mid-caps grew at 21.2%, and large caps plodded along at just 14.0%.
And when you compound anything at nearly 37% over 9 years, the absolute growth is staggering.
Right.
On the surface, the narrative just writes itself, right? The small cap sector is a rocket ship, and the large cap sector is a slow, mature dinosaur.
But the math of averages can hide a lot of sins.
A lot of sins.
Whenever I see a group average that high, especially in a category as volatile as small cap businesses, I get highly suspicious.
As you should.
Isn't this akin to judging a high school classroom's average test score by including that one genius kid who got 150% on extra credit and the kid who never even showed up for the exam?
Right.
Like, the average gets skewed so violently that it tells you absolutely nothing about how the typical student is actually performing.
Right. And the DSP Mutual Fund report actually anticipated that exact suspicion.
Oh, really?
Yeah, they isolated this phenomenon. They call it the outlier effect.
Okay.
To find out what the typical company was doing, they applied a very basic statistical filter. They just trimmed the absolute extremes from the data set.
What do you mean by extremes?
So they removed just the top 2% of the best performing companies and the bottom 2% of the absolute worst performing companies by aggregate profit in each category.
Okay, so just a 2% trim on either end.
Right.
That leaves 96% of the companies completely untouched.
Exactly.
Statistically, you wouldn't expect that to drastically alter the landscape.
You wouldn't. You really wouldn't until you see the underlying fragility of that small cap headline.
Okay.
Because when you apply that tiny 2% trim, small cap profit growth plummets from 36.8% down to 24.8%.
Wait, really?
It sheds 12 full percentage points just by tossing out a handful of edge cases.
That is wild. Okay, and if we apply that same 2% trim to the large caps, I'm assuming they are, much more stable.
Oh, their profit growth barely twitches.
Really?
Yeah, it moves from 14.0% to 13.5%.
Wow. Which tells us that large companies are growing together as a relatively cohesive ecosystem.
Exactly.
But the small cap tier is being violently dragged upward by extreme outliers.
Yes, small cap isn't a unified growth story. It is a label with wildly extreme outcomes.
Right.
A huge chunk of that famous outperformance we read about is really just a few hyper-successful companies carrying the entire sector's weight.
Or maybe, massive loss-making companies suddenly bouncing back to zero and skewing the baseline.
Oh, definitely. The reality of the small cap universe is that it includes highly cyclical companies and businesses with intense leverage.
Okay.
So in tough economic environments, a few of those companies will report catastrophic, like outsized losses.
Which drags the historical baseline down to the floor.
Precisely. And when they eventually recover to just being a normal, functioning business, the percentage jump looks like explosive growth.
Oh, I see.
But it's really just a return to baseline.
Yeah.
Owning the broad label small cap is very different from owning the specific rare companies that actually generated that wealth.
Right, I follow the logic there. But we still have to reconcile the remaining numbers.
So,
Because even after we shatter the illusion and apply that 2% trim, a 24.8% small cap growth rate is still comfortably beating the 13.5% large cap rate.
it is.
So they are clearly doing something right.
Yeah.
I mean, the intuitive assumption here is that small and mid-sized companies must be taking over the market. They must be selling significantly more products than the big guys, right?
You would think so. But to test that assumption, we have to flip our focus from the bottom line profit to the top line, which is revenue.
Okay.
Revenue is the unfiltered reality of customer demand. It's the total money paid to the company before any rent, salaries, or taxes are subtracted.
Right. And looking at the source data, the top line story completely contradicts the profit story.
It really does.
Over the same 9-year period, large cap revenue, like the actual volume of goods and services being sold, compounded at 13.5%.
Right.
That is higher than both mid and small cap sales, which
Yeah.
only hovered in the mid 11% range.
Exactly. The large corporations are actively capturing more market share and growing their sales at a faster clip than the smaller companies.
Wait, the math isn't adding up for me.
Okay.
If the big players are selling more actual volume and growing their revenue faster, how on earth are the smaller guys beating them so soundly on the bottom line profits?
Well, what's fascinating here is that the massive profit beat for small and mid caps over the last decade isn't a story about capturing new markets or inventing new products.
Okay.
It's entirely a story about efficiency gains. It's about margin recovery.
Okay, let's define the mechanics of that. Margin recovery essentially means they are figuring out how to keep a larger slice of the pie they already have.
Yes, we can measure that by looking at the profit margin. So how much actual cash a company retains out of every 100 rupees in sales.
Got it.
If we rewind to FY17, the small cap sector was in a deeply distressed state. Out of every 100 rupees of sales, they were keeping a meager 1 rupee and 30 pays.
Wow.
It was so fragile that by FY18, the small cap group as a whole actually reported an aggregate loss.
Oh, man.
But jump ahead to today, and they have completely overhauled their operations. They are now keeping 8 rupees and 40 pays for every 100 rupees sold.
That is a massive jump. Going from keeping 1 rupee to keeping over 8 rupees is a monumental shift in efficiency.
It's huge.
That means they were slashing middle management or maybe refinancing terrible debt at much lower interest rates.
Or digitizing supply chains that used to leak money.
Yeah, right.
And mid-caps underwent a very similar structural cleanup. They went from keeping 6 rupees out of every 100 in FY17 to keeping 12 rupees and 80 pays today.
So they optimized their existing footprints?
Exactly.
So smaller companies were essentially digging themselves out of a massive hole of inefficiency. I have to assume the large caps didn't really have that problem to begin with. Their margins must have been relatively flat.
You nailed it.
Yeah.
The large caps were already operating as well-oiled machines. They went from keeping 11 rupees and 90 pays in FY17 to 12 rupees and 40 pays today.
Barely moved.
Right. They simply never had a severe profitability crisis to fix.
The PMS AIF LEAP PS translation note has an analogy that makes this dynamic instantly relatable.
Oh, I love this analogy.
Yeah, they ask us to imagine a student who improves their test score from a failing 35 marks to a respectable 75 marks.
Right.
When you look at that on a report card, a 40-point jump is incredibly impressive.
It is.
But getting from 35 to 75 is largely about fixing a broken routine.
Yes.
It's about finally doing the homework, showing up to class, grasping the absolute basics.
Yeah.
But going from a 75 to a 90, that requires a completely different caliber of effort.
It really does. It requires advanced skills, deep conceptual mastery, and original thinking.
Exactly.
And in the business world, That 35 to 75 jump is margin repair.
Right.
You fire the underperforming staff, you close the unprofitable branches, you negotiate better terms with your suppliers.
Just getting the house in order.
Exactly. But there is a mathematical and physical ceiling to how much profit you can extract from a single sale.
Yeah, because you still have to buy raw materials. You still have to pay the electricity bill.
Precisely. Once a company finishes fixing its broken cost structure, that margin repair trick is exhausted. To get from 75 to 90 to keep growing profits in the future, they absolutely must figure out how to sell more products to more people.
But there's a hard limit to that game, right? You can only fix a broken business model once.
Exactly.
Once you're running efficiently, there's no more fat left to trim. So what happens to these smaller companies when we fast forward past that initial cleanup phase? What does the picture look like when their margins finally hit that ceiling?
Well, the data provides a very clear answer if we just change our starting point.
Okay, let's do it.
If we stop anchoring to the distressed days of FY17
Yeah.
and instead start the clock at FY22.
Right, a point where a lot of that initial pandemic era cost cutting and margin repair had already been realized.
Exactly. If we start there, the entire narrative completely flips.
Okay, let's look at the numbers post-2022.
Since FY22, large cap profits compounded at a very robust 15.8%.
Okay.
Small cap profits, however, fell behind, compounding at just 13.7%.
Because they hit that wall. Their margins finally flatlined.
Yes, from FY22 to today, the small cap profit margin barely inched forward. It moved from 8.2% to just 8.4%. Without the artificial boost of massive margin expansion, their profit growth naturally sank below the large caps, because the large caps were doing the hard work of growing actual sales volumes.
Here's where it gets really interesting.
Okay.
If we take that 2% trim rule, the outlier effect we discussed earlier, and apply it to this recent post-FY22 era, the grand illusion completely evaporates.
It really does. When you trim the extremes since FY22, that massive gap between the tiers vanishes. Large caps sit at 15.2% profit growth, mid caps are at 14.2%, and small caps are at 15.0%.
They are all right on top of each other.
Yes.
All three groups, large, mid, and small, converge right around a 14 to 15% growth rate.
Exactly.
Once you remove the extreme outliers, and once the broken companies are done fixing themselves, the entire broad corporate sector is essentially moving in lockstep.
Yeah.
There is just a tiny 1 percentage point spread between the titans of industry and the smaller players.
It reveals a unified underlying economy.
It does.
But while the historical convergence is fascinating, the DSP mutual fund data from the most recent financial year, FY26, flashes a glaring red warning sign about where this is heading next.
Yeah, spend some time looking at that FY26 column, and it is highly concerning.
Very.
In FY26, large cap sales actually accelerated. They grew revenues by 9.4%.
Right.
But small cap sales plummeted. Their revenue growth was an anemic 1.5%. They are functionally stagnant.
And yet, despite those flat sales, small cap profits still somehow jumped 20.9% in FY26.
Which is crazy. If your actual volume of sales is only growing by 1.5%, but your bottom line profit spikes by nearly 21%, that means almost all of that extra cash came from squeezing your operating margins to an extreme degree.
Yes.
They are wringing out a towel that is already bone dry.
That's a great way to put it. And the source material explicitly warns about the danger of this dynamic.
Yeah.
Operating at peak historical margins while simultaneously experiencing a severe slowdown in top-line revenue is a very precarious position.
Definitely.
Extrapolating this recent trend of small and mid-cap earnings growth linearly into the future is a trap.
Right.
You cannot sustainably grow profits at 20% a year if your sales are flatlining.
Eventually, you run out of expenses to cut.
Right.
If you keep trying to engineer profit without sales growth, you eventually have to start compromising on research and development or marketing or quality control.
And then the business actually begins to shrink.
Exactly. Now, we've spent a lot of time in the realm of percentages and growth rates today.
We have.
But percentages can be wildly deceiving depending on the base.
Oh, absolutely.
A 50% growth rate on a neighborhood lemonade stand isn't moving the needle compared to a 10% growth rate on a multinational supply chain.
Right.
We need to ground this in absolute reality. Where is the actual money sitting?
Okay, to see the true scale, we have to look to the absolute trailing 12 months, or TTM profit after tax, up to June 2026.
Okay, and just to clarify, TTM simply means looking at the last 12 months of actual realized cash performance, ignoring artificial financial calendar boundaries, right?
Exactly. It's the cleanest way to look at it.
Perfect.
So across the top 500 companies, there is a total profit pool of roughly 20.1 lakh crore rupees.
Okay, 20.1 lakh crore, that's the whole pie.
That's the whole pie. Out of that massive pool, large caps generate 14.7 lakh crore.
Wait, 14.7. So the top 100 or so large caps are swallowing roughly three-quarters of the entire profit pool for the top 500 companies.
Yes, three-quarters. Mid caps generate 3.8 lakh crore.
Okay.
And small caps, despite all the explosive growth headlines we've been talking about, they generate just 1.6 lakh crore in absolute profit.
Wow. The PMS source highlights a statistic that puts this into stunning perspective.
Yeah, this one is mind-blowing.
For every 100 rupees of new profit added to the entire corporate system since FY22, 71 rupees was generated by the large caps.
Yep.
Only 7 rupees came from the small caps.
It paints a very different picture of who is actually driving the Indian economy forward.
It really does. And there's an efficiency gap here that is just hard to ignore. Small caps produce about 12% of the total sales volume in this 500 company group, but they only capture 8% of the total profits.
And that efficiency gap comes down to structural advantages.
Like what?
Well, large caps have economies of scale. They can borrow money at significantly lower interest rates, they have immense pricing power with consumers, and they can strong-arm their vendors for better terms.
Right, they dictate the market.
Exactly. Small companies are generally price takers in the market, which makes it fundamentally harder for them to convert a sale into actual money in the bank.
So what does this all mean for the listener today who is simply trying to stay well-informed, who reads the financial news and sees endless debates about small cap versus large cap potential? Why does the distinction between margin repair and genuine sales growth actually matter to them?
It matters because we live in an era of intense information overload.
Yeah, that's an understatement.
Right. And it is incredibly easy to confuse the hype of a stock ticker with the underlying reality of a business. The primary takeaway here is a grounding one. Large caps have delivered incredibly strong, durable, long-term profit growth with significantly lower volatility.
Right.
And they're doing it the hard way by actually capturing more market share and growing sales.
They aren't relying on accounting acrobatics or one-time cost cuts.
Exactly.
Yeah.
Now, the smaller companies certainly performed well over the last decade, but the data clearly shows it was predominantly a phase of fixing deeply broken businesses.
Yeah.
And as we established, repairing a broken foundation is a vital step, but it is a maneuver you can only execute once.
Right. You can't go from 35 to 75 twice.
Exactly. Understanding this framework prevents you from looking at a historical 36% growth rate and blindly assuming it represents the permanent future.
It demands that you stop asking what a company's growth rate is and start asking how they actually achieved it.
Yes, the how is everything.
That completely changes how you interpret a headline. I want to thank you, the listener, for taking this journey with us into the actual mechanics of corporate India's earnings. We set out to look past the forced perspective, and the underlying data certainly told a different story.
There is, however, one final macro implication hidden in this data that is worth considering before we wrap up.
Oh, okay. Let's hear it.
We noted that small cap revenue growth practically flatlined at 1.5% in FY26.
Yeah, anemic.
They are rapidly hitting the ceiling of how much they can squeeze out of their profit margins, meaning internal organic growth is going to become extremely difficult for them.
Right, because they can't cut any more fat.
Exactly. Meanwhile, the large caps are sitting on a war chest of absolute cash profits, that 14.7 lakh crore rupees we talked about.
Yeah, massive amount of cash.
And they're proving they know how to grow their top-line sales.
So the big guys have all the cash and the operational momentum, while the smaller players have niche market shares but are suddenly hitting a wall in their ability to scale further. So if small companies can no longer grow by simply trimming the fat, and they lack the leverage to organically capture huge new revenue streams, are we standing on the precipice of a massive wave of corporate consolidation?
It's a very real possibility.
Will these flush, cash-rich large caps simply start buying up the small caps to absorb their market share and keep their own massive growth engines fed?
It's a fascinating structural dynamic.
It really is. It is definitely something to mull over the next time you hear a breathless headline about the limitless potential of small cap growth. Just remember the tourist holding up the Leaning Tower of Pisa.
Right.
The reality of the picture always depends on the angle you're viewing it from. Until next time.